Chapter 13 can be a tough subject, so I want to go over just a few minutes on a breakdown of what you're going to see in that chapter. Here's an example of an issuance of stock. Boomer Corporation issues 2,000 shares of common stock for $10 per share. So basically, if the stock has a $4 par value, we're going to debit cash for $20,000, which is 2,000 times 10. Common stock will be credited for 8,000, and paid in capital in excess of par value will be 12,000. And how we get that 12,000, how we get that 8,000 is we're going to do 2,000 times 4 is 8. And basically this paid in capital is going to be a plug-in number, the difference between this 20 and this 8. So basically down here, stock has $4 stated value. See the difference here is stated, and that's par. The entry is basically going to look the same. However, paid in capital in excess of par value and paid in capital in excess of stated value. So that's the difference there. There's between par value and stated value. Basically the same premise for the example, and it's basically just going to be the same except for that difference. If the stock has no par value, you're going to have a typical debit of cash. We're going to increase cash because we're receiving money because we're selling stock, and we're going to credit common stock for $20,000. Same thing down here. Stock has no stated value, so if there's no stated value or no par value, you're not going to have a compound entry as you see over here. Here are some examples of treasury stock transactions. Boomer Corporation acquires 100 shares at its $4 par value common stock at $15 per share and holds them as treasury stock. So basically, we're going to record treasury stock at cost. So what numbers here do you think will add up to $1,500? We're going to take the 100 shares times the 15. So basically, even though it does have a par value, we're buying it at $15 per share. So it's going to be 15 times 100. We'll give you 1,500. Debit treasury stock. Treasury stock kind of acts like a contra equity account. It's a deduction from your equity because you're taking it back. You're purchasing it back from the market. So now, if Boomer Corporation sells 25 of these shares that I just acquired, this is going to be key in the rest of this scenario down here. We purchased it at 15. Now what we're doing is we're selling it at 18. So the difference between 18 and 15 is going to be 3. So if we take $25 or 25 shares times 3, you can get $75. That $75 will be your paid-in capital from treasury stock. And the way we get cash is basically 25 times 18. Got my calculator here. Just to double check, it's 450. And that difference between the 75 and the 450 will be your treasury stock of 375. Now, keeping in mind $15 per share, we sell 25 shares of treasury stock for $14 per share. So basically, we're selling it for $1 or less than we originally purchased. So that transaction, basically, 15 minus 14 is $1. 25 times $1 will be a debit to paid-in capital from treasury stock, which this is usually a credit. But since we're selling it for less than we purchased it, we're selling it at 14. Remember, we bought it at 15. Don't think of that as a loss because really losses go on the income statement. But think of it as a loss. But we're gonna basically debit an account we normally credit. So we're gonna get 25 times 14 will be 350, and that difference will be the plug-in of actually it'll be 350 plus 25 since these are both debits, and that's the treasury stock will be the credit of 375. Here's a good breakdown. Go in your textbook on page 588. You'll see the shareholders equity section. Basically, have paid in capital and retained earnings, and your paid in capital account or your paid in capital section will have a subsection on capital stock and additional paid in capital. So additional paid in capital and capital stock are subcomponents of paid in capital. The next section is the retained earnings. So paid in capital plus retained earnings less treasury stock will give you total stockholders equity. Again, check that out. Check that out on page 588, illustration 1312, and let me know if you have any questions.